Hi, ladies and gentlemen. This is Tamala Stobbs with the March 2020 monthly market report for Connect Homeowners. We're going to start with the news. We all know the news is about the coronavirus and how it's impacting everything around us. But we're going to leave that to the end. We want to stay focused on the business itself and what's taking place. We're going to go through the monthly market report like we normally would. But at the end, we're going to address at length the whole coronavirus issue. Let's get started with the news because there's a lot of good news. And most people projected the year was going to be a pretty good year to begin with. It's starting off even better than people anticipated. As a matter of fact, in the latest Black Knight report, they said the housing market is heating entering 2020 and recent rate declines could continue that trend, a sharp contrast to the strong cooling that was seen at this same time last year. 2020 started off very, very strong. And part of the reason is as we're recording this, interest rates are at 3.45%, which is more than a percentage point less than where they were last year. ShowingTime's latest report shows that overall, the people out looking at homes right now is up over 20% since this time last year. And as a matter of fact, the report increase in buyer foot traffic is the largest in the history of the ShowingTime Index. And it's increased dramatically in double digits all across the board in every single region. And they're not just looking at houses, ladies and gentlemen, they're actually purchasing houses. The existing home sales report from the National Association of Realtors shows that the overall number of sales is up almost 10% since this time last year, with the South and the Northeast leading the way with double-digit increases. But every region did well. On the flip side, that's the demand side, declines are beginning to increase. This past month was 13.6% for all prices. Houses under $200,000 are down 19%. The inventory available between $200,000 and $750,000 is down 12%. And even the houses over $750,000 are down 5.9%. Now the good news is, according to the U.S. Census Bureau, privately owned housing stocks authorized by building permits in December, which is the last month that they give us, is usually adjusted annual rate of 1.4 million. That is 5.8% above December of the last year. What we're looking at is more new construction is being built, and that's going to help us alleviate some of the inventory challenge. But we have to get out there and make sure that homeowners are thinking about selling, are being helped through that process. Associates explained, with better than seasonal demand trends tightening supply and interest rates near record lows, the pieces are in place for the recent uplift in home price appreciation to increase further in 2020, in our view, by Zelman and Associates. What we're seeing now, the people that are projecting home prices are upticking those projections for this year. And if we go through the 6 we normally give you, we can remember that the 2020 numbers were all in 2s and low 3s the last time we gave you this report. And right now, we can see that the Mortgage Bank Association, Zelman Associates, Fannie Mae, and the National Association of Realtors are all projecting over a 3.5% increase this year. And 3 of the 4 are projecting over a 4% increase in home appreciation. The 2 that are still under 3, Freddie Mac and the Home Price Expectation Survey, remember, they're quarterly reports, they're not monthly reports. And I believe that when their next quarterly report comes out, you'll see that they too will uptick their expectations. Whenever we're talking about increasing prices, the one thing that I'm always concerned about is people starting to say, well, houses aren't affordable. And we do know that from a recent survey from CoreLogic that the leading obstacle to home ownership is people's perception of affordability. Back in 2018, 30.1% of all the people surveyed said that was the leading obstacle to them obtaining home ownership, the affordability situation. In 2019, last year, that number jumped up to 40%. 4 out of 10 people say they want to buy a house, but affordability is an issue. Well, we have to understand, ladies and gentlemen, even when prices are going up, that doesn't necessarily mean it makes houses less affordable. As Mark Fleming, the first American chief economist, explained, when demand increases for a scarce, limited or low supply good, prices will rise faster. The difference between houses and other goods is that we buy them with a mortgage. So it's not the actual price that matters, but the price relative to purchasing power. How much of our annual income do we put toward the mortgage payment? That's the thing that really matters. What is our monthly payment? Historically, that number, if we go back, decades in time, comes to 21.2%. About 21% of our overall income was put towards the mortgage payment. As we can see, because interest rates have been so low, that number has dropped dramatically over the last 18 months. And today stands at 15.5%, well below the historic norm. Now, the same Black Knight report I referred to before, they explained, still, even with home price growth accelerating, today's low interest rate environment has made affordability the best it's been since early 2018, despite the average home price increasing by nearly $13,000. The monthly mortgage payment required to buy that same home has actually dropped by 10% over that same span due to falling interest rates. And ladies and gentlemen, rates are continuing to fall. Black Knight went on to say that, put it another way, prospective home buyers can now purchase a $48,000 more expensive home than a year ago while still paying the same in principal and interest, a 16% increase in buying power. So houses aren't less affordable this year, they're more affordable. And more affordable than they've been in the last 2 years. We keep hearing about this affordability crisis. Understand that the vast majority of those headlines are created in the rental market. What we can see here is that historically the cost of renting, the percentage of income needed to afford the median rent, was 25.8%. That number is up to 27.8%, so the amount of income that you would have to take is much higher than you would have to take if you were buying a house. Plus, it's increasing over historic norms. Again, the numbers on the purchase side of 21.2% historically, and now we're down to 15.5%. And that's important because with low interest, with the percentage of home of your total income that's needed, people have decided now might be the time to purchase. In a recent survey done by Freddie Mac, how likely are you to take advantage of low rates to purchase a new or additional investment property in the next 12 months? 54% of younger millennials, 40% of older millennials, 27% of Gen X's, and 11% of baby boomers say yes. They are likely to take advantage of the low rates to purchase a new or an investment home over the next 12 months. When asked the question, how likely are you to take advantage of low rates to sell or purchase a larger home? So they're talking to sellers now that are thinking about moving up into a larger home. Younger millennials, again, 54%, older millennials, 40%, Gen X's, 21%, and baby boomers, 9%. So when interest rates are down, the consumer is understanding that I could buy more house. Make sure that we understand that we're putting that out so everyone gets that. Now, you're starting to hear debates. So we wanted to cover this. There's more and more talk about opportunity zones. So let's talk about what an opportunity zone is, because I think as we get closer to the election, there's going to be a lot of conversation about that. According to the IRS, an opportunity zone is an economically distressed community where new investments under certain conditions may be eligible for preferential tax treatment. Localities qualify as opportunity zones if they have been nominated for that designation by the state and that nomination has been certified by the Secretary of the U.S. Treasury via his or her delegation of authority in the Internal Revenue Service. Basically, what they're saying is neighbors that have been blighted, they want to put money into those neighborhoods in order to bring neighborhoods back. There's a lot of money being used to do just that. Jonathan Squires, director of Cushman & Wakefield, which is a commercial real estate broker. We saw a push towards the end of the year last year. Opportunity funds are becoming more popular due to the fact that there is a clarity in the guidance. Of the properties that we are marketing in the opportunity zones, 10% to 20% of those deals are now bought by opportunity funds. So what's taking place? Ladies and gentlemen, there's money being put into certain neighborhoods in order to bring that neighborhood back. Now, here's what it means to housing, the real estate market. 78% of the zones had median home prices in the fourth quarter of 2019 that were less than the national median of $257,000. Some 48% of the zones had median prices of less than $150,000 because those neighborhoods have been blighted. The residential real estate that's in those neighborhoods and that's around those neighborhoods, the value had been kept down. They haven't appreciated like they normally would. For example, the median price in opportunity zones, 48% of all the houses are less than $150,000. 16 are between $150,000 and $200,000, and 14% are between $200,000 and $257,000. And 22% are $257,000 or more. So it's lower in homes compared to the national average sales price. But what's going to happen in those opportunity zones as that money's put in there and they bring those neighborhoods back? The residential property of those neighborhoods will also increase. So we're looking at a windfall here right now. If you're working in any community that does get opportunity funds that is labeled as an opportunity zone, in order to find out whether your neighborhood actually qualifies, here are two websites that you can go to. One from Economic Innovation Group and the other from the U.S. Department of Treasury to find out exactly whether your area applies. Well, we covered a lot of information right now, ladies and gentlemen. And as always, we give you the Resource Center. If you want to check on those opportunity zones, if you want to check on any other information that we gave you in the monthly market report, you can go directly to the source. Whether it be an article, whether it be a white paper, maybe it's a study or a survey, we give it to you. Also, new buyer and seller guides are available on connecthomeowners.com. So don't forget to go to the website to download the new spring buyer and seller guides at www.connecthomeowners.com. And that's the monthly market report for this month, except for one thing. The coronavirus is really taking over the news cycle, and rightly so. Now, I want you to understand that there are certain things that we can do in the housing market, and there are certain things we have to realize we can't do. As far as coronavirus itself, I think that the question that came out of that are threefold. Number one, how can I protect myself and my family? Number two, what is this going to do to the U.S. economy? And number three, what does this mean to me if I'm buying or selling a home? From an economic standpoint, I want everyone to understand that yes, the virus has taken its toll on the stock market. As I'm speaking over the last several days, the market's down thousands of points, but we have to realize that every time we had some sort of viral emergency, an emergency pertaining around a virus, the stock market got hit pretty bad. As a matter of fact, we broke down for you all the serious virus outbreaks going all the way back to 2003 and how they impacted the S&P 500. We can see that the SARS back in 2003 dropped the market 12.8%. The avian influenza or bird flu dropped it almost 7%. The MERS virus dropped it more than 7%. And the Ebola virus, 5.8%. The Zika virus, 12.9%. Now, we don't know where the coronavirus is going to end up in that. We don't know, is it going to be, when it's all said and done, double digits or not? But what we do know is that in all those situations from 2003 all the way up to 2016, the market came back, and it came back strong. We'll keep on going over the chances of, will the slowdown in the economy cause a recession? We'll give you that information as we move through if it's appropriate. But, ladies and gentlemen, we need to make sure that we're giving you great housing advice that's within our area of expertise. We're not stock advisors, we are real estate advisors. And that's what you depend on us for. And right now, ladies and gentlemen, what winds up taking place whenever there's uncertainty in the market, and there's uncertainty in the market because of the coronavirus, and there's uncertainty because of the stock market now, and there's uncertainty because we're going to go into the most contested election in American history. That uncertainty causes people to make a flight to safety. In an economic situation, they take money out of the stock market and they put it into U.S. Treasuries. The reason they put it into U.S. Treasuries is because the safest investment in the world. Now, as people moving tons of money into the Treasuries, that allows the Treasuries to give a lesser return on that particular bond. Now, as the Treasury returns drop, and as we speak today, they were under 1% in the first time in history. There's a direct correlation between the path of the Treasury yield and the 30-year mortgage rate. So again, as we're speaking right now, I just looked before I came into this recording, 30-year mortgage rates were at 3.21%. And there are some people projecting we might see sub 3% on a 30-year mortgage. And I'm not saying that's going to happen. I'm saying that's where we might be. Now that's the silver lining in all of this uncertainty. There are so many buyers that now they can buy a house at truly historically low interest rates. There are sellers that have been trapped in their houses because they refinanced a couple years ago at 3.75% or 4%. And why would they possibly ever give that mortgage up? Well, now they could go and make the move to the home of their dreams. And maybe on a monthly basis, because there's tons of equity involved in the houses. Remember, 50% of all houses have at least 50% equity. With the equity they have and the low interest rates, they could move into the house of their dreams for not much more money on a monthly basis than they're spending right now. And it's our job to get this information out to you. So that's our March Market Monthly update. Thank you for taking the time to listen. Remember to subscribe to our YouTube channel below, like, and we'll put some additional information down there, the different links as well, so that you have information that you can access. Hi, ladies and gentlemen. This is Tamala Stobbs with the March 2020 Monthly Market Report for Connect Homeowners. We're going to start with the news.